if seasonality does what it normally does, then we're only a couple of months away from good times starting to roll again. Historically, September and October are pretty good, and January and February are good, and we're not that far from that. So I would say that, well, there's two ways to approach it. One is just be long term, just buy quality and just let it ride until you see the big price, the $10,000 gold market, the $200 silver market, and then start looking at reasons to sell.
My target now, which was raised, I think, back at the end of May, my target now for gold is 7,000. My target for silver is 200. And I think we see those this year.
Financial markets frequently test investor patience through grueling seasonal lulls before launching into aggressive, wealth-generating breakout rallies. Navigating these psychological shakeouts requires tuning out short-term market noise and identifying macro inflections before the broader crowd catches on. John Rubino, an insightful financial journalist alongside David Hunter, a veteran macro strategist, highlight that precious metals are completing their routine consolidation phase and gearing up for an explosive upward move. From an analytical perspective, these temporary pullbacks offer a prime accumulation window before central bank policy shifts trigger broad market repricings. Forecasts project gold surging to $7,000 per ounce and silver scaling $200 within the current cycle following recent technical bottoms. Looking further ahead into the decade, long-term predictions point toward gold reaching an incredible $20,000 and silver hitting $1,000 by 2032 or 2033 as monetary debasement accelerates. Strategic positioning in quality physical metals and miners during quiet seasonal stretches provides an exceptional asymmetric risk-reward profile before explosive momentum takes over. Now, we present the clips from their interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
Probably in the metals than I am in stocks in terms of the exact bottom. We haven't seen enough of a turn yet in equities to be sure, but boy, the reversal in the metals and the miners today is pretty convincing. And I think and prior to that, I saw a lot of things falling into place that told me I think we bottomed 9 trading days ago, and the silver got down under 55, just under 55. Scared the heck out of everybody. And then there were, as always happens in these sell-offs, you get the technicians who jump on the momentum bandwagon, and they always have a lower low that it has to get to before it can turn. And you have all the retail investors and maybe others that listen to that and then all of a sudden say, yeah, we can't have a bottom until we get to this. And it almost always, they have you waiting for a bottom that doesn't come, and then it turns before that and you end up chasing. So I think we may see that again here. Silver is back up. I'm not sure where it is right now, but it was back over 59 this afternoon after War started speaking, and gold's up $60. So we had negative warnings in the metals and big reversals in the afternoon, particularly with the Fed meeting. I think there's a very good chance that we are in the beginning of that reversal. And my call has been and remains that we are going to much higher highs in both gold and silver. My target now, which was raised, I think, back at the end of May, my target now for gold is 7,000. My target for silver is 200. And I think we see those this year. So, nothing has to happen by any specific date, but there's a pretty good chance that it's going to be another steep run like we saw last December and January, meaning you could get, go from, the high 50s in silver and, 4,000 in gold and be at those levels in a matter of a few months. Whereas silver and gold, I think they could top out this year for this cycle. But next cycle, they'll go much higher. I have a 20,000 target for gold by say 2032 or 3, and a 1,000 target for silver. So the tops this year are cyclical tops. The top this year in equities is a secular top. Very different.
Seasonality. This is normally the boring time for gold and silver. And, it happens over and over again. You have this great December, January, and February stretch where gold and silver catch a bid, they go up, the mining stocks spike, and then everybody jumps in and they think, okay, this time fundamentals are going to overwhelm seasonality. And they don't, you have 2 or 3 really boring months for precious metals. And we're in what is historically that stretch. So you put those two together, a nice run that inevitably calls for a correction and the boring stretch of seasonality. And this is kind of what we should be expecting, I think. Now, that doesn't mean that we're going to flatline here. Gold and silver could still go down from here, or it could turn around and start rising from here. But as far as this being anything unusual that's happening right now, this is very typical for basically any market that has a good run and has seasonality. When you combine those two things, you get boredom, and so it's not a surprise that we're living through that right now. If seasonality does what it normally does, then we're only a couple of months away from good times starting to roll again. Historically, September and October are pretty good, and January and February are good, and we're not that far from that. So I would say that, well, there's 2 ways to approach it. One is just be long term, just buy quality and just let it ride until you see the big price, the $10,000 gold market and the $200 silver market, and then start looking at reasons to sell. And on the other hand, seasonality is a real trend. If you want to trade, historically, you would have done very well by being mostly out of the market right now and then getting back in over the next few months. So it just depends on your temperament and how you're playing things. I tend to be more of a, buy this gold and silver miner ETF and expect to sell it when it's quadrupled or something like that, and not really pay attention otherwise.
Beneath the surface of current market stability, severe systemic risks are compounding across global credit markets. High leverage across financial institutions creates a volatile environment where sudden liquidation cascades can quickly outpace central bank interventions. Projections indicate an impending global bust next year that could easily surpass the severity of the 2008 financial crisis. Central bank officials will likely hesitate initially, holding back monetary stimulus due to lingering fears of sticky consumer inflation. However, as credit conditions freeze and asset valuations plummet, policymakers will ultimately have no choice but to reopen liquidity spigots. The Federal Reserve's balance sheet, currently standing near $6.7 trillion down from $9 trillion, is expected to skyrocket past $30 trillion to prevent systemic default. This policy lag will produce intense market turbulence, creating dangerous downside exposure for unhedged portfolios before central banks fully backstop the financial system. Now, let's get back to the interview.
Unfortunately, I fear we are heading for a global bust that's going to change. It's going to force his hand and force anybody who would be in that position's hand. And so I still believe we're heading for a global bust. It keeps getting pushed out because the cycles remain strong. But I thought there's signs under the surface that say next year could be a rough year globally, and certainly the oil situation exacerbates it, whether we're mostly behind us or not. If it isn't, that certainly will exacerbate it. But I think there are signs of a global bust being here next year. If that's the case, ultimately a bust is something I'll define just very simply as worse than 2008-9. There's more to it than that, but and it means that you'll have, because of the massive leverage in the system, you'll have a massive unwind. Leverage, once you start heading into a recession, things start rolling downhill, that leverage really kicks in and causes financial crisis. So I think that's what we could see next year. And if we do, it's going to force the Fed's hand. It's not going to be steady as she goes. It's going to be, we need to do it. My concern is, because of what happened in 2008-9, because of the pandemic in 2020-21, where we printed a lot of money, we expanded money supply big time and expanded the debt big time. My fear is, because everybody said it, Powell said it, Warsh has in one way or another said it, they don't want to go back there. Walsh wants to shrink the balance sheet, which is probably 6.7 trillion now, down from 9. He wants it back to a normalized place where it might be 2, 3, 4 trillion maybe. It was 875 billion going into the 2008 crisis, in October 2008. So we've gone from 875 billion to 9 trillion back to 6.7. I'm saying you could get to 30 trillion because a bust is going to require it. But, Powell said we don't want to ever go back there. That was very bad policy. We want to normalize the balance sheet. We don't want to do zero interest rate policy again. We don't want to just print money willy-nilly or QE infinity. I think Walsh is in the same boat. So that's where their head is at. But it's a very different story when you're faced with a free-falling financial system worldwide, and the only solution you have is money. And it takes time to get that money to a level, what I call right-size policy, that stabilizes things and turns it back up. They're going to be early on in let's say, a recession, and then what's moving towards a bust. They're going to be reluctant to do what in past times we would have done, because they're fighting that war that the last war of 2008-9 or 2020. And so they're going to be slower to react, not quicker. They're going to be, and if we're looking at, if I'm right, this global bust is going to be bigger than 2008-9. That means you should need a bigger response than either 2008-9 or 2020. And in fact, they're going to be wanting to do much less. That means there's going to be a period of time, probably months, where they're going to be behind the 8 ball and slow to respond. They'll be putting money in. They just won't be putting in nearly enough to stabilize things. And then they'll, a month later, they'll say, well, we got to do more. And they'll do some more. And then they'll do some more. So it's going to take many, many months, I think, to get to a right size policy. And in the meantime, things are going to be heading south in a hurry. So that's my fear. Whether it all plays out that way or not, we'll see. But my viewpoint hasn't changed at all.
We've got seasonality. We've got a lot of things going on. Oh, and then, the Fed possibly tightening instead of just hitting this market with massive amounts of easy money like everybody expected them to until recently. So there's a lot of things happening right now, and they're basically cross currents. They're contradicting each other. So there's a lot of at least financial pressure in multiple directions. And I don't think there's any way to say, oh, in the next 6 months, we're going to see this or that. The longer trends are still in place. Governments of the world are borrowing way too much money. That's leaving them no choice but to try to inflate away their currencies. That kind of stuff is happening kind of under the surface now because people aren't paying that much attention to it. But all the other stuff that's going on, I have no idea what it means in the short run. So I think we should probably consider it more as entertainment than actually any kind of investment trend that we need to act on. Inflation is way above the Fed's target. Oil prices are high, which is inflationary. Oil is in everything. So when it goes up, the CPI numbers and all the other related numbers go up too. And that would, in normal times, lead the Fed to raise interest rates, to lean against the inflation that we're seeing now, so it doesn't become embedded and become expected. And then when inflationary expectations surge, then everybody starts front running, so you get the potential for the financial system to spin out of control. Historically, the Fed has leaned against that. Okay. But the new Fed chair obviously went through some kind of a job interview process before he got the job. And that job interview, no doubt, involved Trump or some of his surrogates saying, listen, we need lower interest rates, right? You get that, right? You're going to lower interest rates if we give you this job. And Walsh saying, yeah, of course. I'm glad to do that for you, Mr. President. So I think there's kind of an expectation that we're going to see easier money going forward at some point. While right now there's pressure on the Fed to raise interest rates, or at least not cut them. And we'll see if they subvert our expectations here and do something serious with half a point of Fed funds rate or something, one way or the other. But more than likely, they're just going to sit there again. And that's calming in the short run, but in the long run, current interest rates are already too high for the current financial system to function, because already interest costs on government debt around the world are soaring. The U.S. is up to like $1.6 trillion a year in just interest on its debt. And we haven't even rolled over all the debt yet at higher interest rates that is going to roll over. So the interest cost on U.S. debt is going to continue to rise. And that can be debilitating because we have to borrow that money. And that means we're running a defense budget of like $1.5 trillion a year right now, and interest is going to be that same number or higher, and that guarantees massive deficits going forward, which we of course have to borrow. So that increases interest expense, which increases future deficits, and that could become a death spiral very easily. I would say that you could make the case that we're already in that kind of a death spiral when we are a global military empire who has to borrow to fund our defense budget. And when interest costs exceed your defense budget, you're reaching the point where your currency is no longer going to function in the way it has in the past. So I think we're definitely headed for that kind of a scenario if we're not already there. And that should be terrifying to anybody who is interested in financial stability, because it inevitably leads to chaos out there. And whether it's this year or 2 years from now, I don't know, but we're definitely headed that way.
The monetary foundations of major developed economies are rapidly approaching a mathematical breaking point. Annual interest expenses on U.S. government debt have surpassed $1.6 trillion, officially overtaking total defense spending and exposing deep structural fragility within public finance. As trillions in maturing government bonds roll over into elevated interest rate regimes, compounding budget deficits will compel infinite sovereign borrowing. This self-reinforcing debt trap guarantees that central authorities will ultimately inflate away public liabilities, accelerating the erosion of fiat purchasing power. In our view, traditional equity markets are approaching a major secular top, signaling that passive stock index investing may no longer deliver the reliable multi-decade returns investors have grown accustomed to. Instead, persistent consumer inflation, elevated commodity costs, and conflicting monetary mandates point toward a prolonged period of stagflationary volatility. Surviving this macro transition requires shifting capital away from paper assets tied to depreciating fiat currencies and rotating into scarce, tangible store of value assets. Positioning portfolios early in hard real money will be paramount for capital preservation as the global monetary architecture undergoes a historical realignment. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.